Good morning. Show's Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth. It's a wealth management firm here locally in Valparaiso, Indiana. And we serve clients here in Valpo and Indiana, but also throughout the nation. I'm a registered financial advisor that's talking about money, and the show's Money Matters with Greg here at 103.1 FM, WVLP. And excited to be here. Thanks to Greg Kovach for manning the board today and being our engineer. And also just I want to thank everybody here at WVLP for the opportunity to bring the show to you and hopefully give you some access to some information about the markets and about finance and about some financial literacy type things that we do on this show that may help. So that's our game plan here. It's what we do. It's what we started it for about 3 years ago or so, and we have evolved as time has gone on. We've gone from an hour show to a half-hour show. We've gone from, we've launched podcasts. You can find our podcast on iTunes. Just search Money Matters with Greg and listen in as much as you can, and certainly hope that you do. And thank you for doing that. We have quite an audience nationwide now. We stream. There's number of different ways to access us. So excited to be able to be here. And then also today's the first show we're actually doing with a green screen, so we'll be able to put it up on our YouTube channel. You can find us at Farrell Wealth on the YouTube channel as well. So thank you for being a part of it, and certainly also mention Twitter. You can find us at Farrell Wealth on Twitter, and if there's some topics you'd like to talk about, we're all in. That is the laundry list of the things we like to be able to mention at the beginning of the show, and then talk about the market. We're going to talk about the market today. From last week, just really quickly, for Monday, September 24th, 2018. And then we're going to talk about the midterm mayhem and what could be in regards to the political tailwinds of the midterm elections and how it actually might affect the markets. I want to bring up a couple things that some companies out there in the world are doing to help you get out to rock the vote. And then also a couple other things just as far as tidbits. So to start with the market overall, you can basically bank on the fact that China is officially canceling talks. That definitely happened today. Last week's optimism that trade talks would resume really faded this morning as China canceled future negotiations. They basically said we're out and we're not going to be at the table. This really cites the U.S. continued tariff threats as a roadblock. The U.S. imposed $200 billion in additional tariffs on Chinese imports today, and China has pledged to retaliate with $60 billion in rounds of tariffs on U.S. goods. While we still think the U.S. and China certainly will eventually reach some sort of trade agreement, it is really unlikely that that's going to come before the midterm elections. So that's weighing on the markets this morning as far as overall thoughts, but we'll see what happens. It has been a back and forth, and there has been it's been an intense negotiation between the two. We'll see. So the Dow last week hit fresh new highs, as if there was no trade worries at all. The Dow joined the S&P 500 at fresh new highs last week after the drought that really lasted nearly about 8 months. You basically see the Dow's new high and whether stocks have enough support for economic growth and corporate profits that will build even on more recent gains. History really tells us that new highs after long droughts tend to be followed by further gains. So we want to keep an eye on that, and the likelihood of the recession is in the next 12 months is still very, very low. We are tracking that. We'll bring that to you in the show as much as possible. So far, so good, though. We're not necessarily seeing any recessionary issues. The Fed preview coming up, the Federal Reserve's monetary policy meeting is going to looks like they're going to raise a quarter. The interest rate hike later this week is almost a foregone conclusion. So investors really will focus more on the Fed's projections of the future policy of what might be an economic growth. So we'll see what that looks like. That is certainly taking an effect. I know locally, many of the realtors that I speak with and many of the real estate professionals that we talk with have, as far as mortgages, in regards to getting access to debt, it's really helped, well, it's hurt overall sales. What's happened is the person that was able to get a $300,000 mortgage now is having to look more at 220, 200, and the inventory for those types of homes in that range have changed considerably. So they're very tight. It's a very tight market, and it's interesting to see how this all play out in regards to the Fed raising rates. Many of the people that have been approved for mortgages, what I'm hearing is many of the people that have been approved for mortgages in the past are incapable of receiving those mortgages today. So it's definitely tougher. The week ahead, you're looking at, along with this Fed meeting that's coming up, there's a series of top tier data out of the U.S., including consumer confidence, second quarter gross domestic product. That third revision will come about. Bloomberg consensus is 4.2%. Priorly revised was 4.2 as well. And the Fed's preferred inflation measure, which is the core personal consumption expenditures number, consensus is at 2.0 year over year. So the overseas docket is relatively light. The Eurozone and consumer inflation, producer prices in Japan, producer managers index data out of China likely will garner some attention, but pretty much that's it. Another thing that I want to be able to mention before we stop talking the market is those tech stocks, the tech investments won't be in tech investments for long. What's happened is today, as the opening bell rings this morning, which it did just about an hour and a half ago, big tech players will move to a new home on the S&P 500, and this is the most significant sector reshuffling on Wall Street since 1999. So, really hope that we'll certainly hope that they get their securities deposits back from way back when from the Nasdaq. But what's really happening is the S&P Dow Jones is overhauling its global industry classifications standard, or what they call the GICS. And why this is happening is the reclassification, and then I quote, is a step towards acknowledging the convergence of telecommunications, media, and select internet companies and the overlapping services rendered by these companies. So within the GICS structure, the S&P came out and said that when it was first announced the changes earlier this year, so there should have been the ability to be able to get used to it or get ready for it with all the indices that are out there. They're going to be changing. So Facebook will be transitioned to a revamped communications services sector from the old information technology sector. Alphabet, Twitter, PayPal, and Snap will all have secured U-Hauls for the move, and certainly Apple's staying behind in infotech. Netflix, Disney, Viacom, Fox will all join the communication services squad while leaving Amazon behind in the old consumer discretionary group. So really, it's really interesting to kind of see, because tech has grown to be 26% of the S&P 500, but the reshuffling will reduce the weighting down to 15%. So per the old standards, Facebook, Apple, Microsoft, Alphabet, and Amazon alone had an S&P weighting of 15.6%, and that's greater than both the healthcare and the financial sectors. So really what it means is, and I quote from Zacks, it is very important for investors to understand how reclassification will affect your portfolios, since the ETFs that they currently hold may no longer suit their investment objectives. And that's Zacks Investment Research. Nina Mishra that told CNBC this just last week. The translation to that is $23 billion technology sector spider fund is about to undergo some serious changes today. So just keep an eye on that. I want to make sure that you are watching that and we're bringing it to you. The show's Money Matters with Greg. I'm Greg Farrell, CEO and president of Farrell Wealth. It's a wealth management firm here locally, a registered financial advisor, talking about finances here on this show and anything to do with financial literacy, hopefully helping you and your family with some points and some tips about investments, and also just making sure you have a plan, working the plan, and that you are making sure that you have a strategy in regards to your overall asset classes that you own, and also investing, putting money away, saving, and putting it in the right places. Also, what we bring to you on this show is knowledge about what's going on in the markets, what's going on in the economy on a micro and a macro level, and really like to be able to bring to you some takeaways that you can use and maybe dip into the markets, stay away from the markets, uh, based on what we're seeing and where to go. So again, always having an asset management uh, strategy in regards to your overall portfolio, making sure that you're investing wisely and becoming and being informed as much as possible. That's really what we're here for here at WVLP 103.1 FM. So that is the show, and that's what we're doing. We're going to go into midterm mayhem. Is there going to be midterm mayhem coming about here with in regards to this policy? This policy uncertainty that's out there is really surrounding this upcoming midterm elections. It really may lead to an increase in near-term market volatility. So we're keeping an eye on this, and that's why I bring this up. This is from our weekly. This is from at LPL Research, which is our research department's midterm mayhem. This is on our website at fairwealth.com. You can grab this if you want the hard copy. Basically, that's what it's the template here that I'm walking through, and it's done by John Lynch and Jeffrey Buckbinder, who are both chief investment strategist and equity strategist, respectively, and for LPL. So, really talk about, will midterm elections drive mayhem in the markets? And the upcoming midterm elections, it's really, they promise to be among the more interesting in recent decades. I know it seems like that's said every single election cycle, but it does really seem that it will be certainly interesting. The Republicans can take comfort in elections generally being about the economy, stupid. But on unemployment, with unemployment at multi-decade lows and wages are trending higher, you'd think that would definitely be their message, right? On the other side, Democrats can point to the administration's lack of progress on trade, President Trump's below average approval ratings, a number of House of Representatives seats historically lost in the presidential's first midterm election. This is 29 based on the past 13 such elections over 100 plus years, according to Strategas Research Partners. That certainly looks like history is against the Republicans now. While historical patterns, recent polling data, and really betting sites suggest odds slightly favor that the House flips, what does that potentially mean for policy, and how will markets react is what we really care about. And that's what we want to be able to talk about here. Really, as stock investors, we have mixed emotions about the upcoming midterm elections. On one hand, historically, stock market volatility increases and ahead of elections due to policy uncertainty and not necessarily knowing what things will end up being. But stocks also tend to rebound strongly coming off of midterm election lows. So the S&P has been higher 1 year after midterm election than it was on midterm election day every time since 1946. That's a long time, guys. So the S&P has been higher 1 year after the midterm election than it was on the midterm election day every time since 1946. So we certainly consider history in regards to all of things and projections and trends. We're now entering the most favorable part of a 4-year presidential cycle. So you really want to be thinking about positive vibes versus negative, because that's what history has shown us. When you're looking to enter we're about to enter the fourth quarter of year 2. So the period from the fourth quarter of year 2 through the second quarter of year 3 has historically been the best 9-month period from the entire cycle. And this goes back 120 years on the Dow Jones Industrials. So some of the seasonal boost may have been pulled forward into years 1 or 2, but it may be prudent to really temper expectations some, because the upcoming year, post midterms, pre-election, really historically been the best of the 4-year cycle, in part of the president's efforts to boost the economy with his pro-growth efforts and policies, ahead of the election in year four. We're not really ready to make any market predictions for 2019, but the political calendar is encouraging, and really like to look at any volatility driven by policy uncertainty ahead of the midterm elections as an opportunity to get into the market and to continue with your strategy. This historical pattern is extremely hard to ignore. So while the economic background is favorable, corporate fundamentals are still quite healthy, and it looks really, really positive. Now, what about gridlock? Everyone talks about gridlock in Washington and how that's an unfortunate thing, but is gridlock good? And we often get the question, what political leadership combination in Washington, D.C. is best for the stock market? Well, the easy question to answer by looking at historical returns is a Democrat president and a Republican-controlled Congress has been the best combination for the S&P 500. And this is followed closely by a Democratic president and a split Congress. A divided Congress under a Republican president, a reasonable prediction for the outcome this November, has also been good environment for stocks historically. Now, on the other spectrum, if you go towards the other side, a Republican president and a Democrat-controlled Congress, possible but unlikely in this November, has produced the weakest average returns in the markets. So keep an eye on it. That's what we're doing, and that's why I bring it to you. So I just like to be able to make sure that we mentioned some really good things that are out there that you might not necessarily have known. And being agnostic to voting and as far as party and politics, it's really about the market for us. We really want to talk about how we can help you make some money and invest your money wisely. It is difficult to say whether we can really apply this history to the upcoming elections. So here comes the disclaimer, right, in regards to this. But history does say that it certainly looks positive. Regardless of which side of the political aisle you sort of land on, the stock market has performed extremely well since President Trump took office, with Republican majorities in the House and the Senate. The S&P has risen 29% since the start of 2017 through September 17, 2018, and stocks seem to like the tax reform, so perhaps the status quo really wouldn't be so bad. But the stock markets tend to like gridlock better because it takes away the extremes and really does not disrupt the status quo. I've always said that the stock market really likes certainty. If they are certain that there's going to be gridlock, that's a good thing. So that typically, it usually works, even though it might not necessarily be the best thing for our country in regards to getting things done. But if there is gridlock and it's certain that that's going to happen, the stock market likes that because there's less to worry about. So maybe stocks would prefer a Democratic-controlled House. The House flipping more would be likely than the Senate flipping based on the polling data and the discussions of Washington insiders. But we don't really take sides here. But if you assume a tax reform is the administration's most impactful policy change for the stock market, then the midterm election outcome may be a pretty big market mover. So the president can really unilaterally, he can act unilaterally on trade and sort of mute the market impact of the midterm election. So we'll see about that. But finally, the fundamentals of the economy and the robust corporate profits really should overwhelm the impact of any midterm election outcome. So key policy implications you really need to keep an eye on coming up that would happen are several potential implications that for various midterm election outcomes. One would be taxes. If Republicans maintain control of the House and the Senate, they likely would pursue what is being referred to as tax reform 2.0, which would make the individual tax cuts based on December 2017 permanent, and they are currently slated to sunset in 2026. They may also pursue indexing capital gains to inflation, and this improves any potential after-tax returns for stock investors. Should Democrats take control of one or both chambers, they may try to increase taxes, bolstered by a growing deficit that they may blame on Republicans' tax cuts. So we really think that getting a tax hike, though it is very unlikely, but the Democrats could use the debt ceiling as leverage, like the Republicans did in 2010, 2011, to try to get some spending cuts. Congress must raise the debt ceiling in 2019 with 60 votes that was required in the Senate. So we'll see about that. So that's taxes. Infrastructure. This is the main area that many thought President Trump and the Democrats could work together on, and that has certainly proved more difficult. It really is the initial attempt last year, and nothing was done. Should the Democrats win the House with the debt ceiling as leverage, they may look to repeal a portion of the corporate tax cuts to fund infrastructure spending. A carbon tax is also another possible funding for this Democrats-led infrastructure spending push, and this could really boost infrastructure stocks such as construction and building materials and whatnot. So you want to keep an eye on that. A strong performance by the Democrats, both nationally and on the state level, could lead to the expansion of Medicaid, which would benefit health insurers. You start talking about efforts to control drug prices. This may intensify if the Democrats can take control of Congress. You want to keep an eye on your biotechs, keep an eye on many of the pharma companies, and make sure that the headline risk surrounding drug price controls really has led us to be a bit more cautious on the pharmaceutical industry. So it's something to think about in regards to the elections. And then the last two would be defense. Defense spending is headed higher in the near term, regardless of what happens in November. But the trajectory may be more gradual with the House or the Senate flips. And then energy, Republican leadership should be expected to be friendlier to energy production, which could put downward pressure on oil prices. At the same time, the Trump administration, under the status quo, may be more aggressive with Iran and Venezuela, possibly building a price cushion in regards to oil. So basically, as a summary, midterm elections will obviously be closely watched. The political makeup of Congress could possibly change, which has meaningful policy implications that could move markets. So although we see market volatility ahead of results due to this policy uncertainty, we would expect the political calendar to provide this sort of tailwind for stocks over the coming months. And history says that this is a really good time in regards to the overall markets. The economic corporate profit backdrop that remains really favorable, we've been talking about on the show for quite a while, really just is lining up, that the bias really remains that the United States and China will reach a trade deal shortly after the midterms. Trade risks certainly remain, as does the potential for policy mistake by the Federal Reserve or more flare-ups in weaker emerging market countries. But we really continue the S&P 500 to add modestly to a year-to-date gains over the balance of this year. I wanted to bring to you too, and so that is, so just real quick, that is the market midterm mayhem. You can find that on our website at farrellwealth.com, www.farrellwealth.com, inside of the commentary section tab, and feel free, it's free, and dig in and grab that. And if you're interested in reading the synopsis of the template that I just sort of went over. So the show's Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth, and we are here on 103.1 WVLP. We're also going to be recording and showing this this episode on YouTube. You can find that on our Farrell Wealth channel on YouTube. I wanted to mention real quickly before we close here, I bet you didn't know that there is a push by a number of different companies out there to rock the vote. And since we were talking about midterms elections, I wanted to just bring this up at the end of the half an hour before we close. But there's a TV spot that Levi's is bringing out and makes you want to run through a brick wall basically to vote this November. So if you haven't seen it yet, I highly recommend you check it out. And the idea is it's time to vote. And this is a nonpartisan initiative made up of 150 different companies that have banded together to boost voter turnout because not everyone can afford to ditch work for a couple hours on a random Tuesday. It's really here's a short list of some of the companies that are doing. So Lyft is offering a 50% off promo code to help get people to polling locations. It's also offering free rides to underserved communities. Patagonia is basically shutting down its entire operations for Election Day. Walmart made this really cool website with a bunch of election resources, so if you want to go to that. But bottom line, and this is per a Pew study, PW study, 35% of registered voters did not vote in the 2014 midterms because of work and school conflicts. So this is an example that corporate America is attempting to make it easier and more flexible to go vote. So I just wanted to bring that up. I thought it was pretty cool. So keep an eye on that. We'll be bringing that to you as well. So show's Money Manager Greg. I want to thank Greg Kovach for running the board today and just being simply awesome. Thank you so much. And I hope I was able to add some value to you and your family's financial situation today with some tips and some ideas on some trends. We talked initially about the market, and then we talked about the overall midterm elections and how they might really affect your investments and the volatility of your investments here coming up. Please, again, I know I mentioned a couple times, but check us out on YouTube on our channel, Farrell Wealth. It's Farrall, and our website, anywhere else. But we're going to be doing a number of different things in regards to changing the show and rebranding the show, having some guests on the show, you name it. So thanks for listening. Really appreciate you being here on this September 24th, 2018. Happy fall to everyone, as it's officially our first day here of fall has come and gone. I want to thank everybody for listening and look forward to talking to you next week. Have a great, profitable, and healthy week. We'll talk to you next week.